Most people believe investing in the stock market is complicated, confusing, and risky. They think you need years of expert knowledge. They think you need to spend countless hours analyzing companies. They think you need to track dozens of stocks and constantly react to market news. And because of that belief, many people never take the first step. They wait, hesitate, and lose themselves of potential wealth. But what if I told you that you don't need to pick individual stocks at all? What if 3 ETF can give you broad diversification, consistent growth, and long-term wealth accumulation? No guessing. No stress over which stock will outperform. No complicated strategies that eat up your time and energy. Just 3 ETFs. Today, we're going to break down exactly which 3 ETFs are enough to start investing in the stock market, why they work, and how they can help you build sustainable wealth over time, even if you are a complete beginner. The biggest mistake new investors make is overcomplicating everything. They chase hot stocks. They follow social media investing tips. They jump in and out of trades based on rumors and fear. But history and research show something very clear. Simple, diversified, long-term investing consistently outperforms complex, high-risk strategies. And that's where ETFs come in. ETFs allow you to invest in entire markets rather than betting on individual companies. They give you diversification, growth, and stability, all without needing to be a financial genius. An ETF, or exchange-traded fund, is essentially a basket of investments bundled into a single, tradable product. Instead of buying stock in just one company, an ETF allows you to own hundreds or even thousands of companies at once.
It trades on the stock market just like a regular stock. You can buy it, sell it, and hold it easily.
ETFs are especially powerful because they offer diversification. Your investment is spread across many companies, industries, and sometimes even countries. Low costs. ETFs usually charge lower fees compared to actively managed funds. Simplicity. They remove the guesswork from investing. Rather than trying to predict which individual company will succeed, ETFs allow you to bet on the overall growth of the markets and economies. Many investors believe that true diversification requires a portfolio of dozens of individual stocks. In reality, a streamlined approach is often more effective. By selecting just 3 well-chosen ETFs, you can achieve exposure to the entire U.S. stock market, including large, mid, and small cap companies. Exposure to the global stock market outside the U.S., including Europe, Asia, and emerging markets. Exposure to a stabilizing asset like bonds, which reduces overall portfolio risk. Together, these 3 ETFs create a strong, balanced foundation that is simple, easy to manage, and powerful over the long term. Let's explore them one by one. The first ETF you need is one that tracks the entire U.S. stock market. This single ETF gives you ownership in thousands of American companies, large corporations, mid-sized firms, and small growth companies. From the biggest tech giants driving innovation to promising startups, everything is included. This ETF represents the engine of global capitalism. The U.S. stock market has historically been one of the strongest drivers of long-term wealth creation. It includes companies that innovate, adapt, and dominate industries worldwide. Instead of trying to guess which company will succeed, this ETF lets you own them all. When the U.S. economy grows, this ETF grows with it. For beginners, this single ETF alone provides massive diversification and long-term growth potential. The beauty of a total U.S. stock market ETF is that it evolves automatically with the market. Companies that underperform, struggle, or fail naturally shrink in weight or disappear from the index entirely. Meanwhile, companies that innovate, grow, and dominate industries naturally increase their representation, allowing your investment to benefit from their success without you lifting a finger. You don't need to constantly rebalance your portfolio or react emotionally to headlines, news cycles, or short-term market swings. This ETF adapts automatically as the market changes, letting you remain invested through both bull markets and bear markets with confidence. Because it inherently adjusts to market trends and company performance, it forms the core of countless successful portfolios worldwide. For beginners, it provides the foundation of growth, diversification across sectors, and exposure to thousands of companies at once, making it an indispensable starting point for long-term investing. The second ETF is designed to give you exposure to international markets outside the United States. Many beginners make the mistake of focusing only on their home country, but the global economy is vast, and opportunities exist far beyond the borders of the U.S. An international ETF allows you to invest in hundreds of companies across Europe, Asia, emerging markets, and developing economies. These are companies driving global innovation, producing essential goods, and growing rapidly in sectors that may not exist domestically. By diversifying internationally, you reduce dependence on a single economy and spread your risk across different regions, currencies, and political systems. When one region experiences slow growth or recession, another may outperform. This provides your portfolio with resilience, stability, and the potential to capture global economic growth. No single country dominates forever. Economic leadership is dynamic.
Industries shift as technology advances, consumer behavior changes, and demographic trends evolve.
Global diversification protects your wealth from being tied to one nation's economy, currency, or market cycle. It ensures you are not overly exposed to regional downturns or local risks. By holding an international ETF alongside your U.S. investments, your portfolio participates in global growth wherever it occurs. This is particularly important for long-term investors who want to capture opportunities emerging in new markets and industries, while maintaining balance and reducing risk. In essence, global diversification complements your domestic holdings, strengthens your portfolio, and helps secure consistent long-term returns. The third ETF plays a completely different but equally critical role. Unlike growth-focused ETFs, this one is centered on stability, protection, and capital preservation. It usually invests in bonds, fixed income securities, or other low-volatility income-generating assets.
Its purpose is to reduce risk, smooth portfolio fluctuations, and provide a cushion when stock markets decline.
During market downturns or periods of high volatility, this ETF acts as a financial shock absorber, helping prevent panic selling and preserving your capital. For beginners, this stability ETF provides not only financial balance, but also emotional reassurance, making it easier to stay invested long-term and avoid costly mistakes driven by fear. Most investors don't fail because they picked the wrong investment. They fail because of emotional reactions, fear, and impulsive decisions. Markets naturally fluctuate. Prices rise, fall, and sometimes swing wildly. Without a stabilizing component in your portfolio, these fluctuations can lead to stress, poor decisions, and premature selling.
A stability ETF doesn't eliminate market risk, but it reduces volatility, helps manage stress, and gives investors the confidence to stay invested through market cycles.
By smoothing the journey, it dramatically increases the likelihood that you remain committed long enough to benefit from long-term growth, turning patience and discipline into compounding wealth.
When combined, these three ETFs create a portfolio that is balanced, diversified, and powerful, yet incredibly simple to manage.
The U.S. stock market ETF drives long-term growth and capital appreciation. The international ETF spreads exposure across global markets, reducing dependence on a single economy. The stability ETF provides risk management and reduces volatility during downturns. Together, they give you diversification across countries and regions, spreading geographic risk. Industries and sectors, spreading industry risk.
Company sizes, balancing large cap stability with small cap growth potential.
Economic cycles, ensuring your portfolio can weather both booms and recessions. All of this can be managed with minimal effort, making it ideal for beginners and busy investors seeking a low-maintenance, high-potential strategy. Many new investors feel the urge to add more funds, ETFs, or stocks, thinking that more is always better. But more investments often lead to overlap, higher fees, and confusion, which can reduce performance rather than enhance it.
These three ETFs already provide broad exposure to nearly all investable markets, industries, and asset classes.
They are simple to understand, easy to manage, and have a long track record of effectiveness. For beginners, simplicity is not a weakness. It is a strategic advantage. reducing the chances of mistakes and making long-term investing easier and more effective. ETFs are not get-rich-quick tools. They are long-term wealth-building vehicles. Their power comes from time, allowing investments to grow steadily and compound; consistency, investing regularly regardless of short-term market fluctuations; compounding, reinvesting returns so your wealth multiplies exponentially over decades. By remaining disciplined and avoiding impulsive decisions, these 3 ETFs can grow steadily over time, turning small, consistent contributions into substantial long-term wealth. The stock market rewards patience, discipline, and consistency far more than intelligence, luck, or timing. Even with a simple ETF portfolio, beginners can make mistakes. Chasing short-term trends, trying to time the market, selling during market corrections or crashes, frequently changing strategies based on fear or excitement. Successful investing often comes down to doing less, not more. Stick to your plan. Trust your strategy, and let time and compounding do the heavy lifting. This 3 ETF strategy is perfect for beginners seeking clarity and simplicity, busy professionals who cannot monitor the market daily, long-term investors prioritize growth, stability, and low maintenance, anyone wanting a portfolio that is easy to manage yet highly effective. It's not about short-term excitement, it's about discipline, consistency, and sustainable growth, and that is what builds true wealth over time. You don't need to be an expert to start investing. You don't need perfect timing. You don't need dozens of stocks. All you need is a simple, diversified foundation, 3 ETFs, 1 clear strategy, and the patience to let it work. The stock market rewards those who stay invested, not those who try to outsmart it. If this explanation helps simplify investing for you, if it made the stock market feel less intimidating and more accessible, like this content, share it with someone who wants to start investing. Subscribe for more clear, practical explanations about money, investing, and wealth creation. Because building wealth doesn't require complexity. It requires clarity, discipline, and time.